So between the years of 1955 and 1979, there was a race that was occurring throughout the whole world, and that was the space race. And in the midst of that, or at least in the middle, in 1969, Americans were actually able to place people on the moon for the first time in recorded human history, which is amazing because even the phones that we have, cell phones, the computers in them are way more advanced than the most advanced computers to be able to do that. And it's such a great accomplishment. And it's interesting because on that historic day, there was actually a phone call that was made. And this is something I didn't know, and I feel like a lot of people don't even know, but it was termed the longest distance telephone call. That happened between the astronauts on the moon and the president of the United States at the time, which was President Nixon. And there was a delay between 1.3 seconds for the signal to go from Earth to the moon and back, so it's 2.6 seconds or about 3 seconds delay. Anyway, I was reading an article a couple weeks ago that talked about how Nokia Bell Labs actually made a contract with NASA for $14.1 million to put 4G on the moon, and so and later that can actually be upgraded to 5G. Which we're doing here on Earth right now. So who knows, maybe you can get better service on the moon than here on Earth. What's up guys, this is Tyson. So it turns out you probably will get better service on the moon because there's nothing to block this signal, so random fact. Anyway, I was trying to do an intro for the first time, and I want to be able to cover some interesting things that's going on in the world, whether it be in finances or business, something that's related to that. So, and who doesn't like space? So anyway, comment down below if you want to see more of that kind of stuff. I wanted to kind of switch gears of what I'm going to be talking about. So I've been talking about banking before, but actually I want to talk more about the investing part. So there's actually a lot of things that you can invest in. There's investing in yourself, investing in a business, or investing in real estate. But the thing I want to really focus on is kind of more of investing in the stock market, because that's what I actually really enjoy. So I kind of want to help by creating a foundation, and that's by kind of going over the emotional part of investing, because it is like a roller coaster ride. It's kind of like an inverse correlation though, because usually on a roller coaster ride you're going up, and then once you go down, that's the fun part. But at least with investing, it's the opposite, where when you're going up, that is the funnest part, but once you start going down, that is some hard things to swallow sometimes. The thing is about a roller coaster ride is usually you don't just go down, you don't go just straight up, you usually go up and down, and that's how the market is. Except generally just in the market, if you look at the course of the whole US stock market as a whole, it's always gone up in the long run. I want to kind of talk about my very first investment, and that was actually in waste management. And so when I first got it, I was either 16 or 17 at that time, so I was pretty young, and I put thousands of dollars into it. And I was like, okay, let's see this money start growing. Anyway, I just remember distinctly that after I bought it, and like a month or two afterwards, I'm super excited. I wanted to check it every single day, even though I wasn't selling it at the time. It went down. And me being young, I was just like, well, I put a lot of money that I worked hard at my minimum wage job, and just to see my money just start disappearing. And I'm like, this is not fun at all. Why am I doing this? There's no point. But later on, it turned out to be one of my best investments, and that's because I held on to it. My dad actually told me there's times where if the market starts going down as a whole, or things are just not turning out the way it is, sometimes it's just better to not even look at it, because you start getting those emotions, and then you want to start selling, or you want to sell at a loss, and you just start losing money that way. And actually, if you look at daily traders as a whole, they generally don't make money, because it's just a buy and hold strategy is a lot more effective. So I want to talk about a theory that kind of talks more about this, and about the value of gain and loss, and that's actually called loss aversion, which was later developed by Amos Tversky and Daniel Kahneman, which I don't know if I said that right, but here's their names right here. They later termed it as prospect theory. And if you kind of look at this graph over here, it kind of shows a relationship between how much money you've gained/lost with how valuable you think it is. So if you're looking at it, you can kind of see how if you gain 5 cents, the value is approximately like 16. So you're pretty happy with that. But if you do the opposite direction where you lose 5 cents, your value is at over -40. So overall, that's just showing a stronger correlation of how you respond to a negative stimulus versus a positive one. And so they actually, there's psychologists that actually looked into this because we're humans, we have our brains that has a reward center, and in that reward center, when we gain money, we feel happiness, we feel joy, and that's the reason why gamblers actually have a problem with, because when they get a little bit of that, they just want more and they crave it and they do it over and over. But it turns out they actually lose money, and that it goes to the opposite, that your brain actually responds by chemicals in it. So that's the reason why investing is such a hard concept sometimes, because once we start going down slightly, we start to panic. That value is a very strong number, and that's basically our emotions. And so when the stock actually goes down, people sell their stock and take the loss on it, where usually in reality it fluctuates and goes ups and down, like I said earlier, and it usually goes back up and it goes up overall. So when you panic, you lose money, and when you don't and hold on, usually it results in a better result. So you can kind of see this in prospect theory in this example, where it talks about how a mutual fund or a collection of stocks or companies in a fund that you can invest in, how one of them, it's kind of a different point of views. So if you ask yourself, do you want the stock that's been performing over 12% in the past 3 years? You'd be like, of course. But if someone told you, hey, I have this stock, it's been doing better, but over time it's kind of doing worse and worse, which one do you want to invest in? So they're actually the same mutual fund. And so your perspective can really change the way you invest. And so there's also different point of views that you can actually take, or the people that actually fall victim to. For some of these, it can be like an anchoring trap, where you look at a company in a certain perspective, but rely so much on a certain fact that you lose sight of everything or how well the company is doing as a whole. I did this with a company, it was a 3D company, where I was just like, oh, 3D printing, that could be the future of manufacturing. Everyone can be making their own things at home, so manufacturing is going to be increasing, and it's a revolutionary technology. Anyway, I got so obsessed with that fact that I just didn't see that the company as a whole was not doing well, and it actually completely collapsed, and I ended up losing thousands of dollars from that. That was a very bad mistake, but I'll talk about that more in a different video. So the biggest example I can think of anchoring is the buy price that you get a stock or a mutual fund or whatever you purchase. So for example, if you bought a stock at $10 and it goes up to $12, what do you base that off of? And that is the $10, because you're anchoring your thoughts to that $10. And one thing I think that a lot of people need to be careful about is when a stock actually increases in such a value, say it's gone up 30%, you start to focus on, oh, I'm up 30% from that price. So if it goes down percent, it's like, oh, I'm still up 20%, I'm still good. But if there's a 10% drop, and that should be a concern if that continues long, and maybe you won't realize it until you're closer to that anchoring price. And it's just something to think about while investing. There's other traps that you can fall into, like a sunk cost trap. There's an example where if you buy a movie or tickets to a movie, and say they were expensive for some reason, you spent a lot of money on this, you hear some reviews and it says this movie is terrible, don't go to it. Everyone's saying it's terrible, it's just a waste of money. So what do? Do you still want to use those tickets that you bought that you can't refund to a movie that you're gonna absolutely hate, or do you just not go and just say you just cut your losses? And so a lot of people would actually still go to the movie because they spent that money, so they might as well get something out of it. So kind of like those tickets that I was in that example, it can kind of compare it to investing with a 3D company also, how I went down a lot in value, and I could have just been like, well, I already bought it, I'm just going to keep it because it's going to rebound, but I didn't know the fundamentals of it, and so I'm actually really glad because my dad actually ended up selling it, so I am lucky. And so it's just kind of these kind of perspectives that really can affect how the way you invest, and it's some of the fundamental things that you need to really kind of have a grasp on before investing, because if you don't, you can actually lose a lot of money because it goes down, you lose money, and you panic. Anyway, so that's just what I wanted to talk about today, and hey, if you like content like this, hit the subscribe button, hit the bell, get notified. So there's some links down below if you want to try investing for the first time with money that is, or free money basically. You can sign up with Robinhood and get a free stock. If you sign up with Webull, you can deposit $100 and get a couple of free stocks also. And it's good to be able to get your toes a little bit wet so you can kind of experience this emotion of investing, because sometimes the market goes up and sometimes the market goes down, and overall, you just gotta buy and hold. Unless there's a problem with that company, then you should probably sell. But overall, you just want to buy and hold, and that's kind of some of my philosophy of investing. Anyway, I hope you guys enjoy that. And yeah, hit the notification bell, subscribe. I appreciate all the support. Anyway, thanks guys. See ya.